Our market panel. Joining us now is Neil Dutta from Renaissance Macro Research, Meghan Shue of Wilmington Trust. Guys, happy Friday. Neil, GDP this week stronger than expected. Core inflation today softer, but a lot of weakness in top-line growth leading companies to cut costs. So what does this mean for potential rate cuts and for stocks?
Well, I think with the companies, it's always, when things are going well, it's my strategy. And if they're not going well, it's the economy. I don't really buy it. I mean, the economy is fine, John. It's fine. Private domestic demand is running at about 2.5%. The important thing is that inventories have been unsustainably drawn down over the last year. And ultimately, what's going to have to happen is that retailers are going to need to restock their inventories. And when that happens, there's going to be a boom for the manufacturing sector as those inventories are restocked. At the same time, core inflation is moderating. It's moderating more rapidly than I think the Fed believes. By March, they're going to revise down their core inflation forecast yet again. And I think that sets them up to either cut in March or use March to set up a cut in May. But I do think the die is cast at this point for the Fed to be cutting relatively soon. We're on a glide path to 2% inflation.
Okay, so that must, Meghan, be music to your ears because you still expect 5 rate cuts. I guess Neil just made the case, but with GDP so strong, why?
Yeah, well, this is really interesting because for the better part of 2023, all we talked about was really this idea that if growth is strong, inflation is likely to also be hot. And what we've seen is that has really disconnected, and we've been able to realize better than expected economic growth with inflation coming in lower than expected, all while real wages are elevated for consumers, which has helped the consumer part of the economy. So I think we have to sort of get rid of this idea that good news for the economy means that the Fed has to stay more hawkish. And we've been looking a lot at real interest rates, and they are restrictive. And as inflation continues to come down, we expect that the Fed will react and that they'll ease policy so that they don't overshoot and passively tighten, if you will. So I think good growth is good for the economy, and inflation is likely to stay on track for hitting the Fed's target by this year.
But Neil, what if we do get a so-called no landing scenario that plays out? Is that still good news is good news from a Fed standpoint and an inflation standpoint? I mean, pending home sales today, well ahead of estimates, the highest since April. In general, we're seeing signs that housing is bottoming or stabilizing here. You've got a pipeline of spending that is really going to start to materialize and hit the economy this year, whether it is the Inflation Reduction Act or the CHIPS Act or all of the infrastructure policy that has been signed into being in the last couple of years. I mean, how real is the risk that you do get a no landing scenario and that inflation doesn't continue to keep falling the way it is?
Well, you're getting a mid-cycle refueling, but it's clear that inflation is still moderating, right? I mean, I think I think that's the bigger point. I mean, the risk to the economy was really at its peak when the Fed believed that a recession was necessary to quell inflation. It's been clear that even as the economy has been growing, that recession is not required in order to do so. You still have, you mentioned the pipeline of growth. There's a pipeline of disinflation, particularly in housing rents. And keep in mind, Morgan, that used car prices actually rose over the last 3 months. And despite that, core inflation's been weak. What we know about wholesale auction prices suggests that used car prices will be deflating in the first quarter. And when that happens, core inflation will look even weaker. So, I take the point. I think the things that you're pointing out are important, but I think all that really does is put a ceiling on how many cuts the Fed can end up delivering. It doesn't stop them from actually cutting. That's about inflation.